Hello everyone. The topic for this video is adjusting entries. This video will look at adjusting entries for Gulf Coastal Design Studios for the month ended January 31st. Several accounts need adjusting entries to recognize revenue earned and expenses incurred, even though no cash has changed hands yet. In this video, we're covering two of the five adjusting categories for the company, accrued revenue and accrued expenses. Both share one idea. The revenue or expense happens first and the cash moves later. We'll look at two accrued revenue examples where the company has earned revenue but hasn't collected it, and three accrued expense examples where the company's incurred a cost, but it hasn't paid for it yet. The other three categories, prepaid expenses, depreciation, and deferred revenue, will all take place in another video. For this problem, you've been asked to analyze the effect that each required adjustment has on the accounting equation. Determine which account should be debited and credited to record each adjustment. Prove that the accounting equation balances, and determine the effect that the adjusting entries have on the income statement. Our chart of accounts includes accounts receivable through interest expense, or letters A through J. Notice that there is no cash account involved in adjusting entries. Adjusting entries are internal transactions and never involve cash. Keep this chart visible. We'll use these letters instead of writing full account names as we cover each transaction. Let's start with accrued revenue. On January 31st, the company completed $2,000 of design services for a client. The invoice will not be sent out until February. The work is done. The company earned this $2,000 in January, but no bill and no cash yet. We create a receivable here. The client owes $2,000 and service revenue increases right along with it. So we see an increase in our assets on our accounting equation and an increase in stockholders' equity because revenues increase stockholders' equity. We'll debit A, accounts receivable, and we'll credit F, service revenue. On January 1st, the company loaned $12,000 to another business, accepting a notes receivable at a 5% annual interest rate. No interest has been received yet. So the company is the lender here. So it's earning interest even though nothing's been collected. 1 month's interest is principals times rate times time, for $12,000 times 5% times 1/12 for $50 of interest. We multiply by 1/12 because the rate that's stated is an annual rate. In other words, it's a rate for 12 months. So if we're calculating the interest for 1 month of the year, we have to multiply by 1/12. That $50 is owed to the company. So interest receivable, which is an asset, increases, and so does stockholders' equity because the interest earned is interest revenue, and revenue always increases stockholders' equity. We'll debit B, interest receivable, and credit G, interest revenue. To sum up accrued revenue, if the company delivers the service or provides the goods, it has earned revenue, regardless of whether cash has been received or not. If cash hasn't been received, then at the end of the month, an adjusting entry has to be made. Now let's switch our focus to accrued expenses. Accrued expenses are the mirror image of accrued revenue. They are a cost incurred, but not yet paid. We have 3 examples here. Let's look at an accrued expense involving interest first. On January 1st, the company borrowed $24,000 from a bank at a 5% annual interest rate. No interest has been paid yet. Now the company is a borrower. 1 month's interest has been incurred, so we multiply principal times rate times time. $24,000 times 5% times 1/12 equals $100 owed for January. We use 1/12 because interest rates are always stated on an annual basis, and we're calculating interest for only 1 month or 1/12 of that annual rate. We will increase our liabilities for the interest payable and decrease our stockholders' equity because of interest expense. Any increase in an expense will always decrease stockholders' equity. When it comes to debits and credits, we'll debit J, interest expense, and credit E, interest payable. Another accrued expense that's very common are salaries. Employees earned $2,800 in salaries during the last week of January to be paid in the February payroll. Here, there's no calculations needed. The work is done. The full $2,800 is incurred. Payday just falls in February. So what we have to do here, again, we have to increase our liabilities for salaries payable, and that increase will be the $2,800, and we decrease stockholders' equity for the salary expense amount of $2,800. Remember, when you incur an expense, it's an increase in the expense, and increases in expenses always decrease stockholders' equity. When it comes to debits and credits, we'll debit salary expense, letter H, and credit salaries payable, letter D. The final accrued expense example deals with utilities. On January 31st, the company received its January utility bill for $350. Payment is not due until February. The bill has actually arrived, but we won't make payment until February. The cost is actually incurred during the month of January and must be expensed during that month, even though cash payment will not be made. For this transaction, we're going to increase our liabilities for $350 and decrease our stockholders' equity for $350. The decrease in stockholders' equity is a result of the utility expense that we incurred during the month. The reason we use accounts payable for the liability is accounts payable will always be used for amounts owed to vendors or suppliers for goods or services purchased in the ordinary course of business. When it comes to the journal entry, what we'll do is we'll debit I, utility expense, and credit C, accounts payable. To sum up accrued expenses, if the cost has been incurred, then an expense must be recorded, regardless of whether cash has been paid or not. If cash has not been paid, then at the end of the month, an adjusting entry must be made. Let's total everything up now and check to make sure that the accounting equation is in balance. Assets changed by a positive $2,050. The $2,000 of accounts receivable plus the $50 in interest receivable. Liabilities changed by a positive $3,250. $100 of interest payable, $2,800 of salaries payable, and $350 of accounts payable. Stockholders' equity changed by a negative $1,200. Since the adjusting entries for revenues were less than those for expenses. $3,250 plus a negative $1,200 equals a positive $2,050, matching the assets exactly. The equation balances. Assets equal liabilities plus stockholders' equity. Now let's take a look at the total revenue and expense columns. Our revenue totals $2,050. Expenses total $3,250. Revenues minus expenses give us a net income effect of a negative $1,200. That negative of $1,200 is the same amount of change in stockholders' equity. Had we not done these adjusting entries, our net income would have been overstated by that amount. The big takeaway here is that adjusting entries are made at the end of an accounting period to ensure that the company recognizes all revenues earned and expenses incurred. For accrued revenue and accrued expenses, the revenues earned and the expenses are incurred even though cash has not moved. I hope this video helps you with your understanding of accruals. Thanks for watching it. Take care.